Welcome in. It is another week of Scrushy on Business. My name is Dave Green. Of course, Richard Scrushy is alongside. Richard, it's great to be back with you after a fun episode last week with our guest, Hunter Carr.
Boy, I tell you, Hunter, he's a go-getter, isn't he? He's interesting fella. Has built multiple companies, made a lot of money in his life, and enjoyed all the stuff that he did in his life. He started so young, you know. What an interesting fella he is, and that Montgomery Ward company was kind of fascinating. You know, what did he say? He was like 20 years old, and he
was
saw the opportunity, Dave.
Yeah, he
Yeah.
had everything happen very young, and he is not young these days, and still has that drive. That's really what I took out of it. Is here's a man who, just like you and I, his hobby, it appears, is working and building businesses, and he has been through it all from starting companies at a very, very young age, just like Richard did, all the way up to continuing to do it today. So that was a fun conversation, which of course you can see by going back on our YouTube page. We hope if you're watching on YouTube, you will click like and subscribe to the page, tell your friends all about it. And we have a fun show coming up today, Richard, and we did a little curveball today.
Yeah, we did. And yeah, I got to say this though. As I'm out and about in different places, I traveled this weekend and I went down to Troy, Alabama and watched Troy's football game. And while I was there, I ran into a lot of people that watched this podcast and they made comments and we talked about the show and about the different guests. And I really had a great time, not only at the ball game, but talking to them about what we've been doing. Now, we had planned on having, an individual here, CEO of a company, was supposed to be here today, but we have other things that we need to do and talk about because it's kind of like current things that are going on. So we have moved that into the future, but we do have multiple other CEOs coming on, and we've been scheduling them. So we got a lot of things going on, and we've got a couple of interesting guests coming to us out of universities. One of them that teaches entrepreneurship. We'll be bringing him on in the future. I've got lunch with him next week, by the way, and we'll be planning that show. And then also I've got the dean of a business school who we're going to actually go into that business school and sit down with the students is the plan. And actually we might even do our podcast from that university with a class of business students. So that's going to be a hoot and that's going to be a lot of fun. So that's kind of planned. But there's some things going on I wanted to just bring up. Many people know that I founded a company called Health South Corporation, and I started that with my own money. I had worked for many years at LifeMark Corporation, about 5 years, and that company was sold, and I had climbed up the corporate ladder all the way, pretty much to the top, and reported to the head guys that ran that company, and I made some money over that, and I had stock options and stock in the company, and when the company merged with another company, I was able to cash out. I took that money, started Health South Corporation, and I hired, 4 guys to help me. We started the company, and of course, it became a multi-billion-dollar company. But in the process of starting that company, again, from ground up, using the money that I put in, we had a game plan, and that game plan was to take the company public. So we set that company up right. Now we've talked about setting companies up, and how do you set it up as a C corp, an S corp? Do you set it up as an LLC? I mean, how do you structure? Well, I had a plan that because I had been working for a New York Stock Exchange company in Houston, Texas. And I understood what it was all about working for a public company and the fact that I'd made some really good money because it was a public company and I was able to get stock options and stock. I wanted to build a public company. So I set Health South up so that it could become a public company, meaning that my first attorney was an attorney with securities experience. He was a security lawyer and he had expertise in when I raised venture capital. He knew how to structure that deal, Dave. I mean, he knew exactly how you structure a venture capital deal. But he also knew when you take a company public, how to put together the filing documents with the SEC and the red herring and all the things that you have to do. He understood the agreements with the investment bankers, how you structure that. But even back to the venture capitalist, he understood how to structure venture capital deals where they got their equity and and how all the documents that they were going to require, to be executed and drafted and whatnot. So I started out right. The other thing I did was I got one of the major accounting firms, and we used Ernst and Young at that time, which was a major accounting firm, to be our accountants and to make and we they of course they have security people there, and so everything we did early on was structured to take the company public and to build a nationwide or an international company. So that was our foundation, and the reason was again was I'd had experience in working in a New York Stock Exchange company that had become $1 billion company, and we sold it for over $1 billion, and I was able to take my equity out of that and then use it to start Health South. But once you become a public company, you're under the rules and regulations of the SEC. And if you're on the NASDAQ, you're under the rules and regulations of the NASDAQ. If you take it to the American Stock Exchange or the New York Stock Exchange, you're under those rules. Now, I do want to say a lot of people don't understand the difference and why do you go to the different ones? Well, you have to have 100 million in revenue to go to the New York Stock Exchange. So you're
Right.
not going to start out there.
Yeah.
You're going to start out on the NASDAQ or the pink sheets or somewhere, but hopefully your company is big enough that you can go ahead and start out on the NASDAQ. Some people go to the American at some point. Others want to go to the big board or the New York Stock Exchange. We took the route of going on the NASDAQ. We did, I think, maybe a couple of years on the NASDAQ, a year and a half to 2 years. And then when we hit the $100 million mark, our bankers, investment bankers, and our board of directors said, hey, let's go on the big board. So we did. Now, once you get yourself into a public scenario and you're a public company, and of course, what was really interesting, and I have to go back, I don't want to jump over too many things, but when you file, we became a profitable company after a couple of years running it. And of course, we started out with venture capital. We did 3 rounds of venture capital to get us public. We had to take dilution. We started out owning 100% of the company,
Right.
and then as you take dilution, what happens too, by the way, and you don't need to have fear of that because a lot of people do. But here's what happens. You may have 100% of this pie.
Right.
Okay, and you think I got it. So, but when you get like this, and
When
you've
you have the
got
bakery.
yeah, and you got a piece of pie that's this big, and you got this much of it, maybe a third of it or 25% of it, it's a whole lot bigger than that pie.
Yeah.
So you might lose control of the when you have to go to a board of directors and you have shareholders that vote every year, and they can vote you out, and they can vote different board members out, and they can put a lot of pressure on you. And if something bad happens to you, you end up with a shareholders lawsuit, or you may have a derivative suit against the management. So all of these, you go into a whole new world when you become a public company, and you open yourself up to all of these different things. And as a matter of fact, the rewards are great, but the risks are great. And so you put yourself out there. Now you're high up on the ladder, and anything can happen. I mean, you can fall, and when you fall, you can fall a long ways because the higher you get, the further it is back to the bottom. Anyways, the bottom line is it's quite a road to travel, and it can be a wonderful road because when you own a big piece of a private company, you know how much money you're making. You can put some kind of value on what that ownership is worth. But when you become a public company and your ownership now is public, and you know that your stock is trading at $10 or $20 a share or whatever it is, and you know exactly how many shares you've got, then everybody knows what your net worth is
Sure.
because they can go and they can see it. Now it's public and it's out there, and it says, okay, well, you've got, 1 million shares and it's valued at $10 a share. Well, that's $10 million, and everybody can look at that and see exactly what you have and what your worth is. And when you get up, you've got 20 million shares, 40 million shares, or whatever. And once you have a public company and you have a board of directors, you can give they can, if you do great things, give you stock options at whatever that current price is. And then as the stock grows, the difference between the offering price of the option and what your stock is trading at, that becomes part of your net worth.
Hmm.
And so your goal then is to continue to build the company and expand and grow the stock price because you have to grow the earnings. And different
Yes.
industries trade at different multiples. I taught a class on public stocks once, and I was able to show all the students, okay, let's look at the airline industry. Let's look at the multiple of the airline industry. And then let's go to the hotel industry. And let's go to healthcare and look at hospitals. And then let's go to, restaurant chains. And you start look and go to energy and, companies like Exxon and Chevron and see what they're trading at. And then go to the automobile industry, Ford and Chevrolet, GMC and all the different companies. And what you find out is there are leaders in those industries. Okay, now let's think about that. So as we look at, I would look at all the airlines and I'd say, okay, what's Delta trading at? What is their PE? PE is your price to earnings ratio. So what that means is you take the earnings per share, and what they do is take the total number of shares, you take the total amount of earnings, you divide it out, and you say, okay, this company earns $1 a share, or $2 a share, or 50 cents a share, and it's based on how many shares you got and what your earnings are. And it's just a division. Okay, and then you will trade at a multiple off of that. And so that's called your price to earnings ratio. Now, what's interesting about that, and I've got to just kind of walk through this, when you look at all the airlines, and if you go on a given day, you pull them all down, and you'll see that some trade higher than others. And as you begin to dig into the research, you'll find out why. Because number one, I remember when Southwest Airlines traded at a very, very high multiple, higher than Delta Airlines. So as you dug into it, well, they were more efficient, they were more economical. Their overhead was less. And you begin to study these different companies, and you find out, why does this hotel chain trade at 18 times earnings, and this other one trades at 12 times earnings? It might have been because they've got a CEO that has a vision and a trajectory of growing and expanding that business at 18% a year. Well, he may trade at 18 times, and that's pretty typical. If you're growing at 18%, you might trade at 18 times. Or if you're growing at 10% a year, you may trade at 10 times earnings. So these things all make sense when you start studying stocks in companies. Well, in the infinite wisdom of our Congress, they came up with this rule called the Sarbanes-Oxley rule, and they wanted every CEO. And this is back when Enron had its crash, and others had problems. They came up with this rule that the CEO had to sign off on all of the financial statements in a company, and when he signed that document, he's saying that everything is accurate. You remember when that came out, Dave?
Sure.
Yeah. And so all CEOs are like, what? And it was criminal. If you signed it and those statements were not accurate, it was criminal. Well, I want to diverse just a little bit here. So just this past week, I think it was last week at the beginning, the company that I founded, Health Health Corporation, which is now called Encompass. I think they bought a home health care agency called Encompass, and they took on that name and changed the name, which is fine. And I read an article that said Encompass Health now faces a securities class action lawsuit triggered by, it talks about that, and said that the stock was hit and dropped $1.2 billion. That news in market value. I mean, so you see what happens when negative news hits, then your stock value goes down. Sure. And of course, then that reduces your PE. You're trading it less. So things begin to change. And these kind of things it will affect all the different industries and how they trade. So the lawsuit alleges that there were misleading earnings reports. And I'm just reading the article straight from the article that I got. It says misleading earnings reports, insider trading by executives. And it says, while CMS, the Centers for Medicare Services, regulatory shifts threaten its inpatient rehabilitation model. And it says that the key risks include reputational damage, compliance costs, precedent-setting penalties, and investors urge to hedge exposure. Okay, and so if you got a bunch of this, they're telling you might want to hedge on your exposure there. As they assess the management's transparency, which I would imagine that has to do with, what really happened. So the case highlights systematic vulnerabilities for for-profit healthcare, emphasizing government risk, long-term valuation, uncertainty for companies relying on regulatory frameworks. And so and it goes into a lot of detail. I don't want to spend a lot of time on it, but apparently,
what does all that mean? Tell us what all of that means.
Apparently, what they're making a claim here that that there's possibility that they had some internal problems that they didn't report because they're making some security claims and violations there. And then they're looking at the fact that some of the senior officers, and I think they're going after, I think one, for example, is the CFO, traded, large amounts of stock back when they already knew about this before it ever hit. So they're making some claims on some insider trading. They already knew there might be some bad news, so they went ahead and sold a bunch of stock. And so that's pretty typical. So when you put yourself out there as a public company, you open the door to all sorts of things. Now, they may not have known that they had these problems and the guy may have just traded some stock and I got accused of that. I traded some stock and they claimed that, you already knew that there were going to be some laws changing down the road. Well, I didn't know that. And of course I had to, that went away because the claims they made were not true. But, I want to go back to this. This is going on right now with that company. And so they're facing that and they're having to deal with that. And they're being threatened by, and I was looking at it and it looks like there's probably about 10 or 12 big plaintiff law firms that have jumped on this that are going against them. And I don't want to make any kind of claim whether they did anything wrong or they're not. I don't know. But then it makes a claim that some of their facilities did not, Medicare said they weren't up to standard. And it looks like they had some deaths in some of their hospitals and whatnot. And they're making a claim there was mismanagement and whatnot. So I don't know about any of that, but I don't want to make any comment about that. But I do want to say that this is the kind of thing that will happen when you're a publicly held company. Anything that does happen is going to be under the microscope. And then you've got all of these plaintiff firms out there that are looking to, to make a lot of money. So they'll come in with a shareholders lawsuit and say, you should have announced this and you should have done that and you should have done this. And, this should have never happened. And
Right.
apparently Medicare is claiming like 34 of their hospitals didn't meet the minimum standard and there was some issues there and whatnot. So, those kind of things. And, we talked the other day, just by the way, and I don't want me to jump around a lot, but remember, Dave, we were talking about when you build a company, you got to put systems in place to make sure that, think about this. We've all been to hotel chains where we thought, well, it's Hilton or and I don't want to say just Hilton, but Hilton or Marriott or whatever, they have a pretty good name. But every now and then you'll go in one and you'll go, man, this place is dirty. The food wasn't very good or the service wasn't very good. And it might be a franchise or something, but you'll find one on occasions that just does not meet the standard that you believe that. And I don't want to pick on Hilton or Marriott because I go to all of them and I like them. But, I'm just using the names, but a name that and this happens in healthcare. You might go to a hospital for it might be Hospital Corporation of America or Tenet or Encompass or any of them, and you think, well, boy, this is not good. This is they don't clean this place. As a matter of fact, I had a call from a patient one time that was a friend of mine and said they were in one of the hospitals, and I don't even want to call the name. They were talking about how they needed to empty the trash and how dirty the restrooms were. And when I ran Health South, I had what was called a pristine audit. And we used to audit, a surprise audit. We did mystery audits on all of our facilities. Nobody ever knew when somebody was coming. I had a whole team that did nothing but that. And those facilities had to be clean. They had to meet all the Medicare standards. We put the systems in place. And, we never had a problem with that. The only problem we ever had was we had some CFOs that did some things they shouldn't have done, and they were caught. And we had to get over that. But as far as running the facilities now, we'll go in restaurants and change. You've been in McDonald's that were subpar. So I mean, this happens. And when you're building a company, or whether you have 10 facilities, 5 facilities, or 1,000 of them, you better have systems in place that run those companies. And every one of your outlets need to meet a minimum standard, and they need to, and that's all about management. But let's go back to Sarbanes-Oxley for a minute. Sarbanes-Oxley, of course, those are the names of, I guess, a couple of senators or congressmen that came up with the rule. But they had CEOs signing off on all financial statements for the whole company. Well, we had over 2,000 facilities. And, we had 1,000 people in accounting, including all of our controllers and all the people in the corporate office, nationwide business office managers. And all of those people had profit and loss statements, and all of that had to consolidate every month. And we had to make that happen. usually by the 15th to 20th of each month, so that we had the financial statements on previous month. And then they would consolidate it all in the corporate office. So it would come in from everywhere. And so you got thousands of facilities in a consolidated. So the CEO has to sign off and say all that's sack for the CEO to do that. And when I went through that, matter of fact, the profit and loss statements would fill a room that's 50 by 50. I mean, it was some huge, I mean, thousands of them. And there's no way that a CEO can sit down and read all those. So what a CEO usually sees when he's running, a company that has thousands of P&Ls, thousands of different facilities, he's looking at just a few pages, and it's going to have, all of that stuff consolidated up, and that's what he gets. So when I was charged with that, and there's some nut on the internet that has out there or something saying that I'm trying to make a claim that I was guilty of Sarbanes-Oxley. Well, I was not. Matter of fact, I was never even tried for that because the judge threw it out because I met the minimum standards. So let's just talk about that real quick. Sarbanes-Oxley, okay? So they require the CEO signs off on everything. So
Right.
I did get a charge for that, and I went to court for it. So I'm in front of the judge, and the judge says to the prosecutors, I don't understand exactly what it is that you want Mr. Scrushy to have done. Would you please bring from Washington, D.C., the people that are in charge of this Sarbanes-Oxley law down here, and I was in Birmingham, Alabama, in a federal courtroom, bring them down here and let them tell me as the judge what that man had to have done to have met the requirements of Sarbanes-Oxley. And so they set a time. A couple of weeks later, the head guy and his assistant flew down from Washington, D.C. They were over the whole Sarbanes-Oxley deal. They came in, federal prosecutors from Washington, D.C. They stood before the judge. I'm sitting in the courtroom with my attorneys. The judge says, are you in charge of the Sarbanes-Oxley program? And he said, yes, I am. I said, well, tell me, what is it that this man has to have done in order to meet the minimum standards for Sarbanes-Oxley? And he said, well, there are two things, ma'am, Your Honor. Number one, he has to have been told by his general counsel that the company's financials meet the requirements of Sarbanes-Oxley. He has to be told, if he signs that document, his general counsel has to tell him he can sign it. Okay, so what is it the general counsel has to do? Well, the general counsel has to meet with the chief financial officer and make sure that the chief financial officer tells the general counsel that, in fact, those documents are accurate so that he can tell the CEO. And then the CFO has to be able to tell the CEO that those documents are accurate. So so they brought in the chief legal officer or the general counsel of the company, and they put him on the stand. And this is all in the record. I mean, everything I'm saying is public record. You can go find this. You can see that this is exactly what happened. So they put that general counsel on, and they said, sir, did Mr. Scrushy ask you whether or not he should sign this document before he signed it? And that general counsel said, yes, he did. And what did you tell him? I told him that he should sign it. And why did you tell him that? Did you verify that these financials were accurate? Did you meet with the CFO? Yes, I did. So what did Mr. Scrushy see? Did he see all of those P&Ls, or did he see just what y'all showed him? He said, well, he saw what we showed him. And he said, Your Honor, you could not fit in this courtroom the P&Ls for this company. It'd be impossible. That's how much space they take up, because we have thousands of facilities. And she said, so he met that minimum standard. He did discuss it with you. What did you bring him? She says, well, I brought him a signature page. And then you told him to sign that signature page. Yes, I did. And did he sign it? Yes. Well, that was the end of it. And she said, looked over at the Sarbanes-Oxley guys and said, is that what he had to do? And he said, yes, that's right. And she says, okay, well, and then she dismissed that whole Sarbanes-Oxley deal and found that I did meet the minimum standards. I did talk to general counsel. I was told that the documents were accurate, and they did have some problem. So, and then the whole thing, all of that just went away. So when you hear that, now a lot of people don't realize that I went to a trial where I was accused of doing some things just like these officers over at Encompass are being accused of the same thing that they accused me of. And I went through that trial and I won that trial. And I beat them on every single count. They found me 100% not guilty on every count. So there was no claim against me at Health South. And so when people, and of course the press beat me up so bad, Dave, that it was everywhere in the press and it's still in the press because the internet, how do you get that stuff out of there? You can't ever get it
Right.
out. So you
Yeah.
can still go find that I did supposedly all this horrible stuff, but I was found not guilty on any of it. And what's interesting is the liberal press, as you know, doesn't want to print the good stuff. They want to print the bad stuff. So they never really cleaned it up and said, by the way, the guy was not guilty on all the bad stuff we said about him. And they piled on, boy, at first they piled on. And that's kind of what they're doing to Encompass right now. They're piling on. So you got these, so it may be that some of the stuff that they've been accused of may not be true. I don't know, but it may be. So, I mean, there are companies where, like Enron, where, that company literally just went away because, most of what they were doing, there was a lot of problem there. Well, Health
Right.
South never went away. There was $7 to $8 billion in assets there, which included hospitals, surgery centers, imaging centers, rehab centers, major properties all over not just in the U.S., but in other countries. And so they had like billions of dollars worth of assets. So you get a prosecutor that goes out to and starts telling Wall Street and telling everybody, oh, there's this huge fraud, and they start selling the stock. Well, that prosecutor actually should have gone to prison for security fraud because they didn't. What she should have said was, oh, by the way, there might be a problem on some of their numbers, but they have got $8 billion in assets, and you certainly don't want to trade the stock down less than $8 billion in value, which they did. But none of that came out. And then also the other things that I personally hired two forensic accounting firms, which we found out that the fraud that those attorneys, that the CFOs did commit, which they've admitted to, never exceeded about $700 to $750 million over a long period of time, and it was actually nowhere near what the claim was. There was not a multi-billion-dollar fraud. We had two different firms, forensic firms, that proved that. But anyways, I just wanted to get back to kind of clarify that whole thing. So people that are thinking about getting into building public companies need to realize that you got to have good attorneys, you got to have good accountants, and you got to really think about who you're hiring to work in your company as your CFO, as your controller, people that you can trust and people that are going to stand up and they're going to help you and help you put the systems in place that will be able to give you accurate reporting. Now, I've said a lot, and I want to stop just for a minute and see if there's anything you want to add there, Dave.
Well, I just think it goes back to the point from the beginning, which is the systems that you have to have in place. As big as the company gets, obviously the buck stops at the top, but the top, as we know, cannot possibly oversee every single thing that is happening in a company. So there is this trust that happens between employees. I worked for a public company in broadcasting where we had to sign a SOX form every quarter, and different market managers would talk about it all the time. We didn't have enough information really to sign the document that we were signing, but we all signed it because either the financial person that was in your market or the person who was involved from a corporate level was the person who was ultimately telling you that this was accurate. But I didn't have access to the bank account, so how could I possibly know different things about what was on the P&L and those sorts of things? I didn't have the knowledge, but I
Well,
did have to sign the form.
you had to sign it. You think about, we had facilities in Australia and the United Kingdom and, Puerto Rico and Hawaii and Alaska, and I'm sitting in Birmingham, Alabama. I mean, it'd be impossible for me to know what they're doing in Alaska every day and whether or not, the numbers that they've sent into corporate office are accurate. So you have to depend on your layers of management. You got to depend on, because we did have regional business office managers, we had controllers in our hospitals and whatnot. And if one of those people are doing something illegal, you just might not know it and you might not catch it. And it can hit you over a period of time. And so you do have to look to your advisors. And so I thought it was really interesting that the head of the Sarbanes-Oxley guy, program came down and told the judge, no, if he had this general counsel tells him everything is fine and that he should sign it, and then he's okay. I mean, he did what he was told to do, and so as far as that general counsel knew, he was being told that everything was accurate by the CFO, and he told me to sign it based on that. And so you can't know everything. I've got a friend, I have to bring this up, and he's a dear friend, and he watches this podcast, and he has a really great development company, construction development company. And he had his bookkeeper over a period of a year or so stole $500,000 from him. And by the time he caught it, and then what that person was doing is they were supposed to be paying bills with checks, but they would write the check to themselves. And then in the books, they would write that they paid the bill. So when he finally found it, he not only lost the 500,000, but he still had to pay the 500,000 in
Yeah.
bills. So he lost $1 million. Of course, prosecutors went in, and I think that bookkeeper is probably going to do some time for that. But here he is running a construction company, development company, and he's got a handful of employees, and right under his own nose, this theft is taking place, and he didn't catch it. So it can happen to anybody, no matter how big you are or how small you are. And I think talking about this on this show makes a lot of sense. And the timing is really good because of what Encompass is going through right now. And again, I don't know whether they're guilty or they're not. I hope they're not. I just pray they're not. And I hope everything is fine. But I think it's something that now they've got to deal with, just like I had to deal with the claims against me, even though they were not true. And I had a lot of claims that we found were not true. And I mean, I went through a trial and I was found not guilty on every single issue. So it's really interesting, and how the press won't come back and say, "Oh, by the way, he was not guilty of any of this," and so we need to back all that off. But that's just kind of the way the world works, And that you were in the media, you see it all the time,
Sure.
and that's a little bit of a problem when we read things in the press. We want to believe it, and sometimes it's just not true.
You're finding that out a lot more.
Yeah. Hey, we got some questions. Hit me with some of those questions real quick that we.
All right, let's get to some questions, Richard. This one came in from your former neck of the woods in Birmingham. Rob asks, how do you personally deal with stress when the business feels overwhelming? We just talked about, obviously, times when there was very high stress for you. As a CEO, you're always busy, stressed, concerned. How did you personally deal with all of that?
You know, and I want to get into a little bit of detail on that, but let me just say this. I forgot one thing that I do need to say. Uh, I mentioned, back when I went through the SEC issue and there was some charges against me and I went to trial and all of that. And I was found not guilty on that. And I mentioned that the fraud never got over $750 million. Well, we were a multi-billion-dollar company. Materiality was $7 to $8 billion of assets, around 350 to 400 million. And that fraud, those CFOs did that apparently over about 6 or 7 years. But the bottom line is, at the time when all of that came down, we put the CFO that did that on the stand. He said there was no fraud at the time when we went through the charges against us at that time. That he had taken all of that over a period of time. He admitted he had done some things, but he said he took it all off the books, so it was all gone. So a lot of the stuff that hit was just wrong, and should have never been said, and then it was overrated, and then the prosecutor said a bunch of things that were not true, and I've had to deal with it for many years. But the bottom line was they didn't have any evidence against me being involved in any of that, and I won that case. Every single account was gone, and I was found innocent or not guilty on all of them. Now let's get back to what you were saying. Yes, stress is incredible. When you're carrying a heavy load, you got thousands of employees, you're running a publicly held company, and you got operations all over the world. And you're dealing with, I think we had like 10,000 doctors that were in our network that we had to deal with. And, a lot of leadership, a lot of management. So you got to stay in shape. And even in smaller companies, I think good health is number one. Good health, being able to work late, being able to work weekends and come back and bounce back on Mondays. Of course, I tried to keep my people from working weekends. Sometimes we had to, no matter what, because we were in the middle of a transaction or deal and we had to get the work done over the weekend. But I wanted my people to rest over the weekend so that they could come back strong on Monday. But you carry a lot of stress. And of course, I'm a man of faith. I truly, I believe that there's certain things in your life that you just need to take care of. And I think family is important. Certainly your faith is first, God first, family second. Those things are important. Your health is next. And if you take care of those three things, you're able to carry a pretty heavy load. And that was my focus. And I tried to manage those three things appropriately and balance all of that in my life so that I was able to carry the heavy load. And interesting thing about it, sometimes I wouldn't get home till 2 or 3 o'clock in the morning. Like I'd be coming from the East Coast, West Coast, all the way to Birmingham. I'd fly in, get to the airport, at 2 o'clock in the morning, and I had to be back in the office at 8 o'clock. Well, you can't do that unless you're in good shape, good health, good mental shape as well. So, and I was a pilot, so a lot of times I was flying the airplane back. So and the other thing too is I I had a mindset that I believed that if I was at work at 8 o'clock, that other people would come in at 8 o'clock. And I found that that was true. And so it sort of set a culture within the organization. People knew, well, he's going to be there. I got to be there. We're going to put in a full day. And because I always knew that that night I could go home and get some sleep and rest and be ready to go the next day. But I hope that answers the question. You have
Let's get
another one?
to Janet from Memphis who asked, Richard, I've got an employee who is talented but toxic. They hit numbers but create drama. How do you decide when to keep someone versus when to cut them loose?
Golly, boy, I tell you what, everybody has one of those, or if not, and if you got more than one, you got a problem because sometimes they'll get going, they'll go at each other. That's a lot of coaching and counseling. That's where you bring them in, and you talk to them and you tell them, you're a very valuable part of the team. You really are, and you do great work. And I love you, and I'm proud of what you can do. But you're going to have to cut some of this other stuff you're doing out. You know, Tell them what they're doing good. Sit down with them, talk to them, and really be frank with them, and just say, if you keep it up, I don't know how it's going to work out long term for you here. I'm not going to be able to make you part of the leadership, part of the team. You know, People that get promoted up need to be well rounded. You've got to be able to get along with folks. You got to have good judgment. You got to make good decisions. You got to know when to do something, not to do something. And you got to be able to, you have to grasp the vision of the company, and you have to grasp the culture, and you've got to be part of all of that. And people that are toxic, that want to fight over things like that, they want to argue. They don't want to, they always find something wrong with the, I had people like that. And some of them I didn't know that were like that, because when you build a big company, you get 3 layers down and you don't see those people very often. And you don't know unless you have a weekly meeting and they come in and they do some stupid things or say some things they shouldn't say. But a lot of times they hide that from the CEO. And you'll hear little rumblings about, well, that guy did this or he said that, and he said this about you, or he said this about one of the other people in leadership, or something negative about a board member or something like that. And then you have to begin to dig a little bit. You say, well, wait a minute now, we don't need to be doing that. And I have on occasions found out that I had a toxic person. I called them in and I sat down with them and I had that conversation. You want to be part of the team or not? This is what you're going to have to do. And sometimes, Dave, I hate to say it, but the people are resent it so much that they get worse. They'll get worse. And those people are not going to make the cut. And that's when if you can't talk to somebody and show them that their negative attitude and the toxic things they're doing are hurting the team and hurting the company and are costing us money and costing us productivity. And if they don't change, you got to cut them. But I always gave them a chance because I'm a nice guy. I tried to talk to them first before I cut them.
Let's finish with this one. It's kind of along the same lines. Ron from San Jose wrote in. I don't know if you had to deal with this in your business or not, but he talks about dealing with family relationships inside a business. Ron owns his business with his brother and says, sometimes negative things happen, like money gets tight and they clash. Any advice for managing family relationships inside a business?
It's one of the most difficult things that you can do. And I've not just seen that, my brother worked with me, and I had other family members that worked within Health South around the country that ended up working with us. And you have that relationship that's family, but then they want to tell you everything that they think is wrong, and you have to deal with it sometimes. And sometimes their view might be tainted. It might not be exactly accurate. So, I've served on boards of companies and worked with companies that have that problem where they had family members, or they had their wife, or they had the kids, and a lot of times, if they're not well, let me give you an example. There was a company up in Memphis, Tennessee, and I met with the CEO of the company, and he had, golly, like maybe 20 family members in his company, and he was losing money. He couldn't get his operation to make money, but he had all these family members drawing all of this money. And when we went to looking at what they were doing, they weren't doing their job. I mean, some of them didn't even come to work, and he's paying them. And so, and he ended up having to sell the business because he couldn't make money because he had too many family members there that were not helping to carry it. So when you got rid of all those family members, the people that bought the business, they did the same work with like 5 people versus 20. And so they were able to bring that cost down
Right.
and make money in the business. So sometimes it gets out of control. And I used to say, if you're going to start a company, probably don't start it with a family member unless that family member is bringing the financing, and then you may have to. But you got to really check it out and make sure that that family member is somebody that is going to pull the wagon, is going to carry a load, is going to work, and is going to be part of the team. Because if they can't sit at the table with the management team and play a productive role, and add value, then now you got a mess going on. You got a situation where how do I get? I got my family member in here, and I'm having to run the company, and I got all this going on. So yeah, it's a critical thing. If it's not a family member, you can bring them in and say, look, let me tell you something. You keep this up, and you're out the door. I'm not going to put up with that any longer. So it is you're adding issues to yourself when you do that. However, I believe that we should help our family members. And if the family members are willing to, when you bring them in, you got to lay it out. You got to explain it to them. Here's what I'm going to just expect out of you. And I'll be honest with you. If you don't do it, I don't know how you're going to be able to stay here. And if you lay it out right and you explain it and you coach and counsel them appropriately, the chances are it'll probably work just fine.
Yeah,
Okay.
everything will work out in the end. And if it doesn't, it's just like any other business problem you have. This is what you signed up for, buddy. So you want to be the top dog. You have to make tough, tough decisions. Well, another great episode, Richard. Appreciate your insights on some things going on in the world today in business. Also, of course, a little history. And then as we take a look at the questions that come in from our audience, we always love to answer those questions. You can email in info@scrushionbusiness.com. Make sure to follow us on social media as well. And of course, if you are watching us here on YouTube, please go ahead and subscribe to our channel. If you are listening to us on your favorite podcast outlet, make sure you follow this show, and we'll be back next week. And Richard, we'll let you have the final word.
Well, here's what I want to say. We dug into some things today that I think were important because a lot of people have questions about, okay, what happened, Richard, back when you were running the big multi-billion-dollar company. And we're going to talk more about that. I mean, we're just scratching the surface right now. We're going to talk about things that are going to be a lot of fun. And I put out a thing on TikTok the other day, said, we're getting real. We're going to dig. We're going to start, we're going to go into some things that are more exciting. And that's what we want to do. We want to make this podcast something that you really want to listen to because it's interesting. And we're going to give you some really cool information. So we want to kind of mix that together. We'll give you some history. We're going to talk about things that can go wrong, but we're going to talk about things that can go right and how you go about building, great companies, successful companies, how you structure it if you want to become public or if you don't want to become public. If you want to be a small company, what I need to do if I'm going to build a national, regional, or whatever. So we want to dig into those kind of things, and we want to be able to provide information that helps anyone who has an entrepreneurship a spirit or has a dream or a business idea and they want to make it happen. So we're going to work on that really hard. I just say, hey, keep coming back because we're going to get better and always follow that dream.